Most Americans think inflation is under control. The headlines say prices are cooling, markets are celebrating. But here's the problem. Inflation doesn't disappear quietly. When it comes back, it doesn't announce itself either. And right now, the data is sending mixed signals that most people are missing. Then the numbers dropped. And before most people even saw the headline, the money had already moved. In minutes, stock markets jumped, bond yields fell, and expectations for interest rate cuts shifted sharply. This wasn't noise. This was a reaction to one number: U.S. inflation, according to the latest Consumer Price Index released by the Bureau of Labor Statistics. Headline: inflation slowed to roughly 2.7% year-over-year, far below the 9.1% peak reached in June of 2022. Core inflation, which excludes food and energy and is closely watched by the Federal Reserve, eased into the low 3% range, down from more than 6% at its peak. On a chart, it looks reassuring. A sharp spike, followed by a long, steady decline. For markets, that curve signals relief. But here's the catch. Inflation data doesn't just describe the economy. It shapes decisions that can move trillions of dollars, okay? And when it's misunderstood, the consequences don't show up immediately. They show up later. The CPI is not a guess. It is the official inflation measure produced by the Bureau of Labor Statistics using tens of thousands of price observations across the U.S. economy. Housing alone accounts for roughly 34% of the index. Services make up close to 60% of core inflation. These weights are why CPI moves slowly, especially on the way down. When inflation surged in 2021 and 2022, CPI lagged reality. Now that inflation is easing, it lags again. That matters because markets treat each CPI release like a verdict, while policymakers treat it like evidence. After this report, Treasury yields dropped by roughly 10 to 15 basis points. In futures markets, increased the probability of rate cuts in the coming year. Equity markets responded as if the hard part was over. But here's the crucial point. Inflation falling from extreme levels is not the same as inflation being finished. To understand why this moment feels so significant, you have to remember how extreme the last few years were. In early 2021, inflation was below 2% by mid-2022. It had exploded past 9%, the fastest acceleration in more than 4 decades. Food prices were rising at double-digit rates. Energy prices surged even faster. Rents climbed relentlessly. The Federal Reserve responded with the most aggressive tightening cycle since the early 1980s, raising rates from near zero to roughly 5.25 to 5.50% in just over a year. Mortgage rates doubled. Credit tightened. Asset prices fell. This was deliberate economic pressure, designed to slow demand. And it worked, at least partially. Goods inflation collapsed first as supply chains normalized. Energy prices stabilized. Headline: inflation fell sharply, but services inflation proved far more stubborn, even in the latest CPI report. Services, excluding housing, remain elevated compared to pre-pandemic norms. Wages, while cooling, are still growing faster than what a 2% inflation target would normally tolerate. This is why the Federal Reserve keeps repeating the same phrase. It needs greater confidence, not hope, not improvement. Confidence. Markets don't wait for confidence. They trade on expectation. That's why this CPI report mattered so much. Investors interpreted the slowdown as confirmation that the tightening cycle is ending on probability charts. The shift was clear. Expectations for prolonged high rates weakened expectations for easing strengthened. But here's the risk. Inflation data is backward-looking. The prices reported today reflect decisions made weeks or even months ago. Housing inflation, which dominates the index, reflects leases signed long before this report. Insurance, healthcare, and education costs adjust slowly, and often in jumps rather than smooth declines. That means inflation pressure can stay embedded, even when the headline looks calm. This persistence is what central banks fear most, because it doesn't respond quickly to interest rates. There is also the issue no one likes to talk about when the numbers look good: data quality. The Bureau of Labor Statistics remains one of the most credible statistical agencies in the world. And the CPI is still the gold standard for inflation measurement, but recent reports were compiled under less than ideal conditions. Data collection disruptions reduced the number of direct price observations in certain categories, forcing greater reliance on estimates and statistical imputation. The BLS has been transparent about this, but transparency does not eliminate uncertainty. Some economists believe this may slightly understate inflation in fast-moving service categories. Others argue that lagging shelter components may be overstating current pressure. Either way, the margin of error matters more when inflation is near a turning point. One noisy data point can shift expectations dramatically, even if the underlying trend hasn't changed. This is where the stakes become real. If markets are wrong, and inflation proves more persistent than expected, easing financial conditions too early could reignite price pressures. If the Federal Reserve is wrong and holds policy too tight for too long, economic growth could slow sharply and unemployment could rise. This is not a theoretical debate. It is a timing problem with real consequences. History offers warnings on both sides. In the 1970s, inflation appeared to fall, only to return stronger after premature easing. Today's economy is different, but not immune to mistakes. The Fed is trying to avoid repeating history, while markets are betting history won't repeat itself. Politically, the inflation numbers are already being used. Lower inflation is presented as proof that policy worked. Critics respond with a simpler truth: prices are still far higher than they were just a few years ago. Since 2020, cumulative price increases exceed 20%. Groceries, rent, insurance, and utilities all remain elevated. This is where public frustration comes from. Inflation slowing does not mean prices fall. It means prices rise more slowly than before. For households, that distinction feels academic when budgets are already stretched. This gap between official data and lived experience is why inflation remains emotionally charged, even as the charts improve. And it's why trust in economic narratives is fragile. Markets, however, care deeply about perception. Expectations shape behavior. If businesses believe inflation is contained, they slow price hikes. If workers believe it is easing, wage demands moderate. Expectations influence reality. In that sense, CPI doesn't just measure inflation, it participates in it. That is why each release carries outsized influence, especially at moments like this. The inflation crisis of the early 2020s is no longer raging, but it is not fully resolved either. Headline: CPI near 2.7% looks encouraging. Core inflation in the low threes shows progress, but interest rates remain restrictive. Government deficits are large. Debt servicing costs are high, and global risks remain unresolved. The economy is balancing, not resting. So what does this report actually tell us? It tells us inflation has fallen sharply from its peak. It tells us the most extreme pressure is behind us. It does not tell us that price stability is guaranteed, or that the next phase will be easy. Inflation is not defeated by optimism. It is defeated by consistency over time. The numbers just dropped. They deserve trust as measurement. But trust is not certainty. The next reports will matter just as much, if not more. And that brings us to the real question that markets, policymakers, and households are all quietly asking. Do you believe inflation is truly under control now? Or are we just living through a temporary calm before the next economic shock?